Welcome everybody. This is the executive summary version of the tax implications of investor behaviour webinar that Peter Bell and I ran earlier today. Quick word on the disclaimer. This is not intended to be tax advice or financial advice, so please seek your own independent advice on those two matters. What we covered in the webinar was looking at two behavioural biases from the psychology and behavioural finance literature, overconfidence and loss aversion. And we followed the train of breadcrumbs through to look at the implications for investing behaviour and the capital gains tax consequences. Then Peter talked to the differences between investment management products that are based in unit trust, the traditional funds management product, versus the relatively newer managed account structure. And then we touched on some solutions. So very quickly, running through the content, we talked a bit about what overconfidence was, how we tend to underestimate uncertainty in our decision making and be particularly optimistic about ourselves and our own choices. This is really the idea that if 8 out of 10 people think they're above average drivers, well, actually the same sort of thing applies to investors, particularly sophisticated professional investors. Then we asked the question, well, why is it that this stuff happens, and what's causing it to persist when really we should learn and overcome it? And this will help us to perhaps put some solutions in place. And we really talked about how we're not getting the sort of feedback that we need, we're not interpreting the right way, and there's a bunch of different sort of self-serving, if you like, biases that mean we feel good about ourselves, but actually we're protecting ourselves from the truth. So what's the implication then for investing behaviour? Well, we looked at the difference between two different types of investors here, a properly calibrated investor who's not subject to overconfidence compared to somebody who is overconfident. And the implication is that the overconfident investor is more likely to buy a company that they think the valuation's above the current share price there, compared with the properly calibrated investor. Same thing on the sell side. So more likely to trade. So then we said, well, okay, if overconfident investors are trading more frequently, what are the tax implications? And we ran through here a 10-year simulation using a 5-stock portfolio. Basically what it showed is there's a $200,000 tax differential between someone who's turning over their portfolio year on year. Every year they're turning over the whole portfolio, compared with someone who's following a 366-day rebalancing strategy. And really that's driven by the fact that you're capturing more of the CGT discounts if you're overcoming overconfidence and not trading quite so frequently. Then we looked at loss aversion, which is roughly described by this curve here. Basically tells us that losses are felt twice as strongly as gains are, same sort of roughly twice the psychological impact. And then larger and larger gains, you can see there's a diminishing psychological impact from them. This curve over here flattens out as the gains get bigger, and similarly the curve flattens out for larger losses as well. So then we looked at the implications for investing decisions from that pattern, and we played out the scenario of the stock going up and similarly the stock going down. We saw why what we're going to tend to do as loss aversion plays out in our decisions is we're going to tend to want to sell the stock that's gone up and to hold the one that's gone down. And that's the pattern that is borne out by the sort of large-scale behavioural finance surveys, both of individual mum and dad investors and also professional investors. So we revisited the scenarios that we'd run now with a sort of another tweak, which is this loss aversion tweak around actually selling more winners and holding more losers. And of course, what happens when you do that is you realise more capital gains, you realise fewer capital losses to offset them. And there you can see that new scenario we've now added to the table that we looked at previously, $146,000. Not quite as bad as the, not quite as bad as the 100% scenario on this side, but worse than the equivalent sort of 50% here, and certainly worse than the $146,000 worse than the rebalance strategy. So those two, overconfidence leading to tax, the loss aversion leading to more tax. Then we looked at the financial implications of different product structures, and this is where I handed over to Peter Bell from Bellmont Securities, who ran through the differences from a tax perspective between traditional managed funds and managed accounts. We looked at the inherited capital gains issue that you might find when you invest in a traditional unitised managed fund product, whereas an investor you might be then subject to the unrealised capital gains that are in that trust when you buy in. Those gains relate to share price gains that might have happened before you bought in, but then as an investor at the time those gains are realised, you're then going to participate in, unfortunately, some of the capital gains consequences from that. Secondly, we looked at the tax parcel optimisation types of rules that you can put into a managed account. Because you've got the underlying beneficial ownership of the underlying shares, you can create rules to say, well, when we are selling some of our shares, let's make sure we sell the ones with the highest cost base to realise the smallest capital gain, if that's what we're trying to achieve. And thirdly, we spent a bit of time looking at switching costs, how when you create portfolios or move from one model portfolio to another, well, you don't need to sell all of the underlying securities to move from one to the other, because often there actually is quite a lot of commonality between one model portfolio and another. And we looked at a real-life scenario of an investor who moved from one to another and looked at the tax differential between doing that under a managed account scenario compared with doing it under a managed fund scenario, and there was a substantial difference there again, and the tax consequences based on those two structures. So then, if there are all these tax consequences of some of these decisions, what can we do about it? And the 4 boxes here represent sort of 4 major themes. Firstly, the direct portfolio management for people who are actually making their own choices, own decisions in relation to forming their own portfolios. What can you do? Well, we talked about sort of some of the questions you might want to ask yourself, the idea of doubling the size of your confidence range when you're actually creating valuations or making predictions, and embedding some of this sort of stuff in your policies and procedures and the rules that you might apply your investment policies, for example, the importance of investment policies. Secondly, we looked at professional management and the idea of finding professional management solutions that are aligned to some of these behavioural principles. So are either putting in place processes and policies that help to overcome the behavioural biases in their own decision making, and or trying to tap into some of the behavioural biases that play out in the market more generally. And we looked at the Bellmont example and how they use the 366-day rebalancing strategy, how they use a systematic rules-based approach to minimise decision making through the course of the year, and also how they try and tilt their portfolio towards some fairly well-known behavioural biases in the marketplace. Thirdly, then, we looked at business growth and client engagement opportunities. Now, really the main theme of this particular webinar is looking at overconfidence, sort of the types of decisions that you might see in a self-managed super fund investor, or perhaps a quote validator type client, the sort of person who's making a lot of their own choices, doing their own research, perhaps likes to have a professional sounding board, someone to bounce ideas off. So that's where the opportunity is, and I think the opportunity there is to use some of these sort of engaging topics around how people think and feel to raise awareness, increase in client engagement around some of these issues, to take the sting out of any particular sort of implications that it might dent their egos too strongly, and also link the sort of the themes, I guess, from some of these behavioural principles back to a value proposition that can ultimately add value to the client. And we've seen how much value some of these tax consequences could add. And then finally, connecting with like-minded professionals, where we talked about the idea that, well, really to overcome overconfidence, we need to recognise the limitations in our own decision-making and skill set. We should recognise that other people have skill sets that might surpass ours in some ways. But what we should probably do then in that case is then complement our service offering and our skill by partnering with those people who align their service propositions, their philosophies. And we talked about how there's some opportunities with the sorts of people who attend the webinars, for example, who come from a range of perspectives, and how they can be connected together. That's about where we left it. So if you're after more information, please see the full version of this webinar, or feel free to contact myself, Simon Russell, Behavioural Finance Australia, or my co-presenter for this session, which was Peter Bell from Bellmont Securities.